Good afternoon everyone, my name is Jeff Halley and this is the weekly commodities and precious metals roundup. I'll go through most of the markets that we have on the OANDA platform. I'm having a look at most of the commodities, energies, soft grains contracts that we have a general chat about the world and have a look at the technical picture and what it may or may not be telling us about the movements in those particular contracts in the coming week. I'm actually looking at the moment at last week's Commitment of Traders report that came out on Sunday night. It's a backward looking report and it does actually give a good picture of the amount of speculative positioning out there in the futures markets. And I'm looking at this report and I can see that WTI and Brent, gas oil, most of the petroleum derivatives are all at weekly highs for speculative long positioning, which means that the market is generally very long those contracts as of a week ago. It's also quite strongly long in gold and silver, palladium, and a few of the grains have some quite heavy positioning in them as well, mostly to the short side, and that may explain some of the price action that we have seen in the last week. Let's just crack on now straight into the gold chart, which you can see in front of you. As we can see, I talked last week about gold having to base between this 38.2 and 50% retracement, this retracement box between 1281 and 1299, and just ahead of this 1296 breakout area. It needed to hold this in order to keep the momentum strong in the upward move we've seen over the last 2 months through July, August and part of September. It hasn't actually done that. It has kept on moving down through this 50% retracement at 1281, which is actually calling the actual bull trend into quite a lot of question now. Part of this is a stronger dollar generally. It's gone quiet on the geopolitical front, but mostly it's the US yields moving high, particularly in the 5 and 10 year tenor. That has made gold much less attractive to hold as an investment item in a fairly quiet geopolitical world at the moment, and it has of course made the dollar stronger. What we've seen here is since last week's report, a constant move down. We've broken this 1281 level, which is now resistance, and we've also had a close through this red line, the 100-day moving average, which is around 1272.70. The retracement today has been a bit of a dead cat bounce, frankly. We seem to have held at the 100-day moving average, and this is actually opening up now a move from a technical perspective down to this 200-day moving average, this blue line here, which is also coinciding, and let me just pop a little horizontal line in here. Let's just grab that bad boy. So we can see here that we in the middle of the chart at around early August, we also had a low there before it resumed its uptrend, and we had the 200-day at 1250. So if we don't get back above this 100-day moving average now, that would imply that we're going to test this 61.8 retrace, which is around 1263 that I'm circling, and then possibly as low as the 200-day. Depending on how quickly it goes, this RSI could be going quite strongly oversold. If that happens, maybe we are starting to see the beginning of the bottom of the gold move down. But a lot of this will depend on the US dollar rather than gold itself. Let's pop over to silver now. Again, a much similar picture. I did mention last week again about it moving into the retracement box, this 38.2, 61.8 level. It has done the same thing. Having said that, if we do move down through there, that does imply that we will move down towards the 61.8 area, which is around 16.185, and then this low here at around 16.1160. On the top side, we do seem to have some traffic now. The 38.2 at 16.96, but also we have moved down through the 200-day and then the 100-day moving average, this red line here. Today that's at around 16.91. What we notice is that when we move down and close below, it's attempted to retrace twice to that line and it's failed both times. So this is definitely a bit of a pivot area. So this sort of 16.9, the 16.90, 17 region is definitely going to see some traffic from a technical perspective. As I said, there were quite extended longs in the Committed Traders report in both gold and silver, and I would suspect that a week after this report has been published, that given that price action, that those speculative longs will be substantially reduced by now. So have a quick look at platinum, which I guess amongst the precious metals you would have to call the ugliest horse in the glue factory. I've taken the Fibonacci off because it's taken out the 61.8 and was looking at the 78.6. We have given back just about all of the up move now in platinum, which tends to be a bit of a heartbreaker. In the best of times, simply due to liquidity concerns, there's just not as much liquidity to move in and out of positions in the platinum as there is in gold and silver. And so when you do get moves, it does tend to move strongly one way or another when everybody runs for the door at once, which is what it appears to be. As we're trading around 912.60 at the moment, we do have this initial support at 908.65, and a break of that would open it all the way back down to the beginning of this trend line, which is around 890. If we squash it up, we can see just how far back it has fallen. And we can also see that last time it popped up above 1,000 in this part of 2017 in February. Again, we had a move almost all the way back down towards this 890 level. And we can see on the longer term chart 1, 2, 3, 4, 5, 6 times we've tested 890. So it's definitely something to be keeping an eye out for traders from a longer term point of view. On above here, quite clearly we have some resistance in the 100 and 200 day moving average zone. This double top here at 945. So between 945 and 958, there is a lot of traffic. Excuse me. But what I want to draw viewers' attention to is the RSI, and we can see now that it's extremely oversold. And this is perhaps a warning signal as we move to this major long-term support that maybe the worst has been seen for platinum. When we look at the Committed Traders report, I can see here that platinum positions have been massively reduced, and the actual futures market speculatively is almost flat in platinum. That combined with the fact that we've come a long way and that the RSI is very oversold could imply that counterintuitively somewhat that maybe platinum is vulnerable to a bit of a short squeeze to the top side. So from a technical point of view and looking combined with the COT report and the RSI being very oversold, maybe just a little caution down here if you're a seller or if you're short platinum. Let's move to palladium, which is most certainly not the ugliest horse in the glue factory amongst precious metals. It's been everyone's favourite precious metal. Again, we can see that it hasn't had a great time of it. We topped out at 941 almost 3 times now, so this becomes quite an important pivot point. And when we go back to early August, we see that it did quite a bit of work around this level before popping up to 1,000. We have support just below here around 902.15, and that coincides with a series of highs on the way up. And then we have the 100-day moving average at 880, followed by this long-term trend line which comes in at 842. But just to give you some perspective on the bull run in palladium, when we look at it from a longer-term picture, like going all the way back to last year about this time, we can see actually that the pullback in palladium up here, when you blow it out, is really quite inconsequential when compared to something like gold, silver, or platinum, of course. Part of this is due to a structural undersupply of palladium above the ground, which they expect will continue out to 2020, i.e. there will be more requirements from producers, from end users for palladium than there is actually available palladium ingots mined out of the earth and melted down and above the ground. So actually, although we are looking like we're moving towards a test towards the downside, you need to take it in context of the whole move. And when we look here, we can see just how important this ascending trend line, which is at 843 today, the 200-day moving average, which is coming in around sort of 824. This region here will be key towards palladium. And from a technical perspective, it's pretty hard to start getting bearish on palladium yet until we see some daily closes below this zone. Let's go over to copper. Copper I've drawn here, don't be frightened by all the lines and everything on the chart. I'm just trying to bring your attention to something that I have noticed here. Overall, copper has been consolidating. If we go to the left of the chart, we see it consolidated here between 2.3 and 2.05, then moved higher, then consolidated for a long time, many months, between sort of the 2.75 and the 2.45 region. Now we've popped higher again and we seem to be consolidating again, and we're moving back down towards the bottom of that consolidation period, which is around this 285 area. So this 285 is a fairly pivotal area, I think, in copper. Now there's lots of drivers of copper, and of course it's very high beta to what people's perceptions are of economic data in China, etc., etc. But I do note from the COP report here as well that it is at 73% of its yearly highs, copper, in total speculative long positioning. And when I look at the price action for the week passing it, I can see that we've been in sideways consolidation, 297 down to about 290 and a half. So that would maybe imply that there won't be seen as a great reduction in those long positionings when we get next week's COP report on Monday morning. But I do want to bring your attention to one thing, and that's the possible formation of a head and shoulders pattern. We can see here I put the S's here and the H. I think it's still too soon to say whether this is a shoulder or not, but I did some quick calculations today. Copper has actually fallen 9% from its point at around this 284. Back down to its present levels. That's about 9% of the entire up move. But if we actually extend this and take this as the neckline, then that gives us a potential target of around 257, 258-ish. So I'm not saying that it's confirmed as a head and shoulders pattern yet, but it's certainly well worth keeping an eye on. A break of this sort of 285, 284, 70 region will perhaps signal, if it happens in the next week or so, that long-term pattern does have validity, and we could be in for a substantial move lower in copper. Of course, we need to get through these 100 and 200-day moving averages as well, particularly that 200, because copper has been nowhere near it for, well, the best part of a year. Let's move to natural gas. Moving to some of the energy set now. Some people may say I have far too much hot air than gas, but hopefully you're still listening and enjoying this little roundup of commodities in the OANDA world. Natural gas, hard to actually really get excited about this unless you're a range trader, and I'm not going to dish you for doing that. Good money to be made out of range trading. Let's just blow this up. We can see here, with the exception of a few little spikes and a few days outside of this pattern, that since May, we've still been range trading between 3.107 and 285.60. I think the important level on the downside is this 275.40. As we're running into the end of the US summer, natural gas should actually pick up the consumption and everything as it gets cold and people need to heat up and etc., etc. Power plants need it for generating more electricity during winter. It's quite surprising that it's actually sitting down here near its recent lows, but from a technical perspective, it's neutral on the RSI, and it's most certainly still range trading in this rather large rectangle, which is great. You can buy it at the bottom of that and sell it at the top of that with some patience and make some good cash if that's what floats your boat. But I'm not going to actually get excited until we see either a break of this 275.40 or we see this 310 on the top right hand side, 315 level break, and a few daily closes above it. Let's go to the oils. It's our friend Brent. There's been a lot of talk over the week about why Brent has failed. I think part of it is that there's been a lack of new drivers, new news to actually drive Brent through that massive 60 level. I think it'll take a few more data points in order to get that. Secondly, if we look down from the peak to this to the very bottom, to the RSI, we can see, as I was talking about last week, it was very, very overbought on the RSIs, and oil does actually usually tend to respect the RSIs, to be honest. When it's very oversold or overbought, usually we do see a correction. In this particular case, it's been one-way traffic, and I think part of this is also because of the extended long positioning that we've seen in the speculative futures contracts. So people have bought oil. They've probably bought it, a lot of it, when it broke out of this long-term resistance region. Let me squash this up to give you a bit of perspective. They probably bought some on a break of 55. So maybe, excuse me, they're actually long at not very attractive levels, and thus their holding power from these high levels is not so great. And what we're seeing is a lightening up of that extended long speculative positioning. Thus, when any sort of bad news comes out, it gets construed as very bad news, and everybody runs, the week longs in particular, run for the exit door. We can see a couple of things though. This dark blue box is something that I've been talking about for a very long time, and this was the I think let me just draw this down a little bit. I've got a little bit. There we go, around this 57 level. This sort of 55.5, 57 level. We can see over the course of the last 12 months how often Brent has topped in that. We finally broke out of it, and as you can see, once we did break out of it, we had a massive spike high very quickly on stop loss buying, and also probably models buying, model funds buying the break as well. We are now back to this region again, so for the uptrend to remain sort of semi-intact, we really do need this breakout region to hold, the low being 55.5. Behind here we have 54 sort of 70, and then we have the long-term uptrend, which is way down at around 53.5 today, and we can see how well this has actually held all pullbacks, and we can sort of see just how far, perhaps ahead of itself, Brent got itself just by how far it moved away from this trend line. Behind there we have, of course, the 200-day moving average around 52.35. So we actually do have quite a large layer of support around these regions, but in the short term we really do need to see the contract hold around this level, and not to forget that Brent, the prompt futures are in backwardation, which is a structurally bullish sign for the contract. The commitment, not the commitment of traders, the crude inventories, the API tonight, the official DOE, Department of Energy, tomorrow night in New York, will now be very, very closely watched. Similar picture in WTI. It hasn't had the same crazy rally that Brent's had, and there's a few reasons for that, which we discussed last week. But we can see, though, more importantly, this, and this line's moved a little bit. Don't know how it does that, but there we go. Right, we can see that the uptrend line that's sort of basically held every single pullback in WTI for the last 2 months got solidly broken last night. We've had a massive close below it. We dropped by about 2%. Again, extended long positioning from speculators in the WTI contract. It's running at about 100% of its maximum long for the year, which means that basically, to put it simply, traders are as long WTI as of last week as they have been at their max all year. And by then, I would probably think they would have been long in as we approach this this resistance box up here. Net result is, of course, everybody's long. The news is gone, and so is their P&L. So they're long and they're wrong, and they've all headed for the exit door at once. So any sort of sniff of a bad news, everybody runs for the exit door. We've been consolidating today after that big move overnight. The obvious support level is initially around this 49.15 area, which is a few daily lows from early September, and also the 200-day moving average. Resistance is now way back up here at this 52.50 area. Support again appears at the 100-day moving average at 47.60ish. I will draw your attention to this grey box to the left. Bit like Brent crude, this is the sort of area which held all the rallies through to the end of last year and the early part of this year, when everybody suddenly got bullish on oil before US shale came and hedged massively by selling futures and took the wind out of the whole move. So we can see multiple daily highs in this region. So this comes in at 53.5 to about 54.80, 54.70. You can put this one away in the back corner, but for people to get really seriously bullish on oil, I think we really do need to see this box broken, this level, this region, and multiple daily closes above it before we can start getting excited. Good news is that this contract is no longer extremely overbought. Like Brent, it has actually moved down to more neutral levels. Right, after all of that, let's move on to some of the softs. So look at sugar, our artery hardener. And it's been a bit of a sideways week for sugar. There's a lot of structural shorts in sugar in the futures market. That is pretty much unchanged from last week, so traders have not been reducing their short positions in the market. Unsurprisingly then, we have seen a little tick up this week in sugar as those shorts have been taken back since I last spoke to you last Tuesday. But what I've noticed here is that when we broke down through the 100-day moving average, the actual red line itself held all rallies after that, yeah, which looks a bit negative. But what it does tell you is that the 100-day moving average is important as a pivot level. So if we were to move back above that and close above it, that would imply that we would then have another test to the top side. Having said that, it does actually make quite clear and delineated resistance in the short term. In the overall picture though, going all the way back to June, we are still in a range trading mode. This 12.5 cents a pound to 15 cents a pound, this 2.5 cent range. And I think a bit like natural gas, until we see a break either to the top side or to the downside, it's a little hard to get excited about sugar at the moment. Let's go to soybeans. I got all excited about this chart last week, and to be honest, I sort of still am actually. We are still consolidating in this range pattern, and we can see this beautiful symmetrical triangle. This does mean that soybeans is getting ready for a breakout. What I can't tell you is with any certainty as to which way it could be. I mean, looking at it now, it does look like it could be to the downside. We have, in the overall bigger picture, been ranging between the 100-day, the red line, and the blue line moving averages. As I said, I can't really tell you which way it'll go. All I can say to you is that initially now, at a break of, 976, and today that'll be 948. A daily close above those or below those could imply that we are actually in for a very large move when you actually start measuring the base of that triangle. I suspect this will be a story for next week, but if it's still consolidating to this apex, you'll probably hear me even more excited next week than you will this week. There has been some news out from the WASDA, the Department of Agriculture WASDA report, which is this seal report on all things agricultural in the United States. Came out last week, and they were expecting a larger than anticipated soybean harvest. And with the Mississippi River at very low levels, a lot of this beans and grains get moved down the Mississippi. If the river's at very low levels, then it's very hard to move all that produce out. So hence these prices have been falling as tariff rates have gone up by 900% if you're a farmer trying to move your produce on a barge down the Mississippi this week. Fat fingers there. Let's move on to corn. We roll into the home straight here. Again, we talked last week about this potential breakout of this beautiful symmetrical triangle, and this is exactly what's been happening. This WASDA report, WASDE, and I'm not quite sure how if that's the correct pronunciation, but that's how this Kiwi's going to say it, did imply late last week that the corn crop was going to be, the harvest was going to be lower than expected. We were going to see lower inventories. Unsurprisingly, that led to some buying of corn futures, and we saw corn break out to the top side. Now, if I look at the Commitment of Traders report, I can see that there are still some very, very large structural short positions out there in the corn futures market, the speculative market, and this perhaps explains to some extent why this triangle broke to the top side with a lower harvest. Having said that, this long-term resistance line here at 347.50, it's held both of those rallies at the top start of the triangle and the breakout very nicely indeed. So clearly, I think if this was to break, that could imply that we'll be underway again, and this big blue arrow that I've drawn here is what I have as the target for a move to the top side now from a technical perspective. And we can also see it coincides beautifully with both the 100 and the 200-day moving averages around sort of that 359.50, 360 level, so mark that in your books. I love it when technical indicators all come together, so the base of the triangle, the 100 and the 200-day moving averages all coinciding in one region says to me that this is a very important region indeed. So time will tell, but that would be the theoretical technical target. On the downside, if we move down now through to this 329.50, to be honest, if we move down through 335 and 332, that would obviously call this move into question. But for now, even though we are trading slightly lower at the moment, it does look like a textbook breakout, just for now. Finally, we'll move to wheat. Come on, system. Okay, so we talked yesterday about moving, last week about moving to the 100-day moving average. We did pretty much when we broke out of this 200-day move up and to the 100-day where it actually failed around 4.40. This is quite important resistance now. The 100-day is still sitting around this 440, 441. What happened was the OANDA USDA report came out, and it was predicting a much higher than expected spring wheat harvest, which meant that the wheat hadn't been as badly affected over winter. The winter crops as anticipated, so more wheat equals lower prices. When you combine it with countries such as Russia with their record high harvests, it's sort of offsetting droughts and rains in Argentina. So wheat futures have moved lower, and this has dragged down the cash CFD contract. If I look at the wheat contract here, it is actually showing still quite a heavy number of shorts in the market, about 40% of the years to date. So it is substantially reduced, but there is still quite a chunky speculative short out there. This makes that this 4.4 level even more important. And also, if we were to draw a little uptrend line here, let's pop that down here, down to here. We'll get around. It's never as accurate as when I do it on live, but you can see what I'm trying to say here. So we do have support around this 4.20, and then a break of that implies a move to this 4.10, and then the sort of the 393.50 is the really important longer term support. A break of this would open up a move down towards the 370 area, looking at the technical picture. A breakout of the 100-day moving average would imply we're moving up to the 4.6 region. Given the size of the harvests around the world and the harvest anticipated in the United States, it could be just a little hard to get super bullish on grains if we manage to break up to this 460 region. Okay, well that's it for this week. Hope you've found that somewhat useful. I would like to wish you all a fantastic week and great trading and good luck out there. Thanks very much for listening in, and cheerio.